Good morning and welcome to the Bulls, Bears, and the Bell Morning Edition Deep Dive. We are kicking off what looks to be a really high-stakes week, October 27th. And, well, the market is just brimming with confidence, isn't it?
Absolutely brimming. It's almost palpable.
So our mission for you today is really to decode that confidence. I mean, you see the indices surging, hitting all-time highs, just massive optimism everywhere. But that faith, that optimism, it's about to run headfirst into, frankly, the most rigorous test, the most data-intensive test of the entire quarter.
That's the perfect way to frame it. We're looking at a market that feels aggressively priced for, well, absolute perfection.
Perfection.
And it's built on, what feels like a pretty fragile foundation of two key hopes.
Yeah.
The sources you shared, they really lay out this central conflict nicely. You've got this powerful dual catalyst narrative. That's the simultaneous hope, right? A breakthrough in U.S.-China trade talks and the near certainty of the Fed easing up. And that narrative is colliding, directly with this gauntlet of earnings from the Magnificent Seven companies, plus some really crucial economic data coming out basically right now.
And the challenge starts immediately.
Right.
Today, Monday, October 27th. We kick off with pressure points right out of the gate. Durable goods orders this morning.
Yep. 8:30 a.m.
And then we get these essential ground truth reports, as you call them, from consumer companies. Thinking Keurig, Dr. Pepper, Revity.
Those are key. KDP, RVTY.
And these are really the first tests, right, to see if all this macro optimism we're seeing reflected in the futures market actually lines up with what's happening, on the ground with businesses and consumers.
Exactly. Does the story match the reality? That's what we start finding out today.
Okay, let's dig into that momentum engine first.
Yeah.
Because if you look at U.S. index futures this morning, I mean, they're signaling a significant gap up, pushing us toward maybe even past those all-time highs again.
Yeah, the thrust is strong.
And this bullishness, it seems almost entirely down to these two big global tailwinds that have sort of converged at the same time. Let's start with the diplomatic side, this mounting optimism around a U.S.-China trade breakthrough. What's actually fueling this? Is it concrete?
Well, it seems to be a bit more than just the usual hopeful talk, which, let's be honest, we've seen plenty of times before.
Right. Been there, done that.
The sources are pointing to what feels like palpable progress this time. You had key delegations meeting recently in Malaysia.
Okay.
And out of those talks, we're hearing citations of a preliminary consensus being reached. That's interesting language.
Preliminary consensus. Yeah.
And maybe even more importantly, there are reports about establishing a very substantial framework for actually de-escalating things.
Framework. That's the key word analysts like to hear, isn't it? Suggests structure, something more solid than just agreeing to talk more later.
Exactly. It hints at a structure for stability. And that possibility that we might actually get a durable resolution is something the market absolutely eats up.
Which leads right to the big focal point expected later this week. This high-stakes meeting between former President Trump and China's President Xi Jinping.
Yeah, that meeting is really seen as the linchpin, the thing that could cement this de-escalation.
And if it actually managed to strike a lasting deal, what's the market implication?
Oh, it's immediate. It's profound. You basically reduce a huge chunk of global geopolitical uncertainty just like that.
Okay.
Which instantly boosts expectations for future global economic growth. That narrative flows directly into market buoyancy. It's textbook risk on.
Right, yeah.
It helps cyclicals. It supports commodity prices. And maybe most importantly, it lifts the earnings expectations for all those big multinational corporations. That uncertainty discount just vanishes.
Oof. Okay, so that's the diplomatic tailwind, big one. The second engine, though, the monetary tailwind.
Yeah.
Arguably, this might be even more powerful for asset valuations, especially here in the U.S.
I think you're right.
We're talking about the near certainty of more help, more accommodation from the Federal Reserve.
Near certainty is the right phrase. Investor sentiment got this. Just massive shot in the arm last week. Remember that cooler than expected CPI print?
Yeah, the Consumer Price Index data. That seemed to seal the deal for a lot of people.
It really did. It felt like the market's final piece of confirmation. As we're talking right now, the trading desks, they're pricing in, get this, a 98.3% probability of a 25 basis point rate cut when the FOMC meeting wraps up this Wednesday, October 29th.
98.3%.
Wow.
So, I mean, for all practical purposes, that rate cut is baked in. It's a done deal.
It's a foregone conclusion, absolutely.
Which brings us to this, fascinating paradox right at the heart of this whole rally. The market's cheering the Fed going dovish, right?
Right.
Which is great for valuations. We get that. But that dovish pivot is happening because there's mounting evidence the economy is weakening.
Yeah.
Labor market softening, growth slowing down. How do we square that circle? Why is bad news economic weakness being treated as such a powerful, good thing for stocks right now?
Yeah, it's that fine line the market's trying to walk. And honestly, it speaks volumes about how addicted we've become to liquidity over the last, well, several years now.
Right, the easy money fix.
In this particular phase of the cycle, signs that inflation is cooling off and the economy's maybe softening a bit, they're not being seen as a threat to future company revenues. Not yet, anyway.
Okay.
Instead, they're being interpreted as absolute assurance that the Fed will keep the easy money flowing. The flow of cheap capital is like the only thing that matters right now.
So the thinking is just bad news means slower growth, which
Yeah.
guarantees lower rates, cheaper borrowing.
And justifies paying higher prices, higher multiples for assets.
Yeah. Investors are, at least for now, prioritizing that availability of liquidity over, the actual underlying health of the economy.
So basically, the market prefers the rate cut over the cure, which would be like strong organic economic growth.
That's a good way to put it. But if that's the case, this whole setup feels, fragile. What's the specific risk here? What breaks this bad news is good news game?
Well, the risk is kind of twofold, and it ties directly into everything happening this week. First, the economic weakness can't get too scary. It has to stay in that sort of benign weakness zone. If it starts looking like actual recession,
Uh-oh.
then the narrative flips fast. Second, and this is crucial for this week, if the corporate earnings we get, especially from the big guys, show that revenues and profit margins are already getting seriously hit by the very slowdown the Fed is reacting to,
Yeah. Well,
then investors will suddenly stop celebrating the rate cut and start panicking about collapsing profits. That optimism we're seeing in the futures, it could turn out to be incredibly brittle if, say, the Mag 7 deliver an earnings shock later this week.
okay, so that deep-seated optimism, it's not just talk.
Yeah.
It's translating directly into, really unified action across the trading dashboard this morning as of, 8:20 Euro AM Eastern? The quantitative picture is just screaming textbook risk on.
It really is a sea of green.
Let's look at the U.S. futures first. Surging, poised to challenge, maybe even push past those all-time highs we just set.
The moves are pretty substantial, indicating real conviction, I think. S&P 500 futures right now showing a gain of 56.5 points. That's about 0.8%.
0.8%. And that implies the underlying index already tagged a new all-time high, 86.47 in the pre-market.
That's right, already hitting new territory before the bell even rings.
And the NASDAQ 100 futures, leading the pack this morning, up 295 points. That's 0.9%. What does that kind of leadership, that bullishness in the NASDAQ, tell you about how big funds are positioning themselves just hours before this critical week really kicks off?
It tells me they are all in on the Magnificent Seven story. The NASDAQ leading like this reflects just massive targeted bets being placed ahead of that tech earnings gauntlet.
Right.
It confirms the main thesis out there. Investors aren't just buying the market, they're specifically buying the AI narrative.
Yeah.
And, the technical picture backs this up too. Both the S&P 500 and the NASDAQ are flashing clear buy signals, according to analysts, and the NASDAQ specifically is noted as being in a rising trend channel in the medium-long term.
So suggesting this isn't just a quick pop, but maybe has some legs.
Yeah.
Some structural momentum.
That's the technical interpretation, yeah, not just a dead cat bounce.
And this momentum, it really kicked off globally, didn't it? Let's look at Asia. They reacted first overnight to those U.S.-China trade headlines.
Oh, Asia was absolutely the engine overnight. Japan's Nikkei 225 surged an incredible 2.5%.
2.5%.
And hit a huge milestone, both symbolically and historically. It smashed through the 50,000 mark for the first time ever, closed at 50,512.32.
Wow. 50,000 on the Nikkei. Just pause on that. Why is that number such a big psychological deal for Japan, especially given the decades of stagnation they've had?
It's massive. For literally decades, the Nikkei was the poster child for stagnation, right? Often struggling way below levels it hit back in the 90s.
Lost decades.
Exactly. So breaking 50,000, it's this powerful psychological signal that maybe, just maybe, the economy has finally shaken off that deflationary funk. It signals that global capital is flowing back into Japan seriously.
And it's not just trade hopes driving that, is it?
No, it's also boosted by these market-friendly policies coming from the new Prime Minister, Sana Takaichi. It really adds credibility to this idea of a sustained global recovery. And elsewhere in Asia, China's Shanghai Composite up 1.2%, Hong Kong's Hang Seng up 1.1%, mirroring that same optimism.
Okay. Europe, meanwhile, seems a bit more measured, taking it in stride. German DAX up slightly, 0.2%. UK FTSE 100 basically flat.
Bit more cautious, yeah, absorbing the rally.
But if we turn to the wider cross-asset picture, currencies, commodities, bonds, that's where we get the final confirmation. This really does look like a perfectly coordinated textbook risk-on trade playing out.
It's a beautiful convergence from a trader's perspective. Look at currencies first. The US dollar index, the DXY, it's softer this morning, down about 0.15%.
Okay, so for folks listening, the DXY, that's the dollar's value against a basket of other big currencies, right?
Yeah.
Euro, yen, pound.
That's the one.
So why is the dollar weakening right now?
It goes straight back to that 98.3% probability of a Fed rate cut we were just talking about.
Yeah.
A rate cut lowers the effective yield you get on dollar-based assets. When that expected yield drops, the currency just becomes less attractive to global investors looking for returns.
So they sell dollars, buy other things.
Exactly. They rotate out, causes dollar weakness. And dollar softness is just a classic symptom of risk-on sentiment as capital leaves the perceived safety of the dollar for assets elsewhere that offer potentially higher rewards but also higher risk.
Got it. Okay, moving to commodities. Crude oil is looking firm, trading $61.67 a barrel, up about 0.28%.
Yep, crude oil confirms that implied growth story. If the U.S. and China are playing nice again, well, that implies stronger global economic activity down the road.
It means more demand for energy. Makes sense.
Naturally. Now, contrast that with gold. Gold is down 1.3% to $4,058.71 an ounce.
Okay, down over 1%. Why the divergence?
Gold is seeing what traders call profit booking.
Profit booking. Break that down simply for us. What does that mean?
It just means investors who are holding gold, likely as a safety play.
Right, the safe haven.
They're now selling it to lock in their profits from its recent run-up, and they're taking that cash and redeploying it into riskier assets that look more attractive now, namely stocks.
So selling safety, buying risk.
Precisely. When you see money flowing out of gold and into equity indices like this, it's a very clear signal that fear is receding and conviction in the growth story is high. It's literally selling your insurance policy to bet on growth.
Okay. And finally, the bond market. Fixed income. The 10-year U.S. Treasury yield. It's holding pretty firm, just about 4%, around 4.029%. Now, this feels a bit weird. If the Fed's about to cut rates, shouldn't bond yields be falling? Lower rates usually mean lower yields, right?
Normally, yes. And that's the final, really essential piece of this whole cross-asset puzzle. You're right. The expectation of the rate cut should be pushing yields lower.
But it's not.
But it's not, because this overwhelming risk-on move is so strong, investors are actively selling their safe haven bonds.
To buy stock.
To buy the surging stocks. And that selling pressure on bonds is counteracting the downward pressure from the expected Fed cut, keeping yields relatively stable, even slightly firm.
Wow.
It shows that right now, the market's excitement about growth in stocks is actually outweighing the dovish pull from the Fed. The entire dashboard, every dial, is pointing towards profound, unified, bullish conviction.
All right, we've painted the picture of optimism. Now let's shift gears to the immediate reality checks, because today, Monday, gives us the first real chance for that optimism to potentially crack, starting with the 8:30 a.m. Eastern release. The advance report on September durable goods orders. This feels like the first big test of that whole bad news is good news regime we talked about.
Absolutely. This is the litmus test. And it's interesting because the consensus forecast is already pretty low. Analysts are expecting, kind of muted results. The headline number is forecast somewhere between plus 0.3% and minus 0.5%. That's a big slowdown from August, which was a strong plus 2.9%.
Okay, quite a drop expected.
But more importantly, look at the core durable goods number. That's the one that strips out the really volatile stuff like defense spending and aircraft orders.
Right.
That core number is only expected to rise by a tiny 0.2%.
0.2%. Okay, why do analysts focus so much more on that core number compared to the big headline figure?
Because the core number gives you a much cleaner signal about actual business investment. How healthy are companies feeling? Defense orders, big aircraft deals, those are huge, lumpy contracts that can swing the headline number all over the place and don't really tell you about broad underlying demand.
Right.
When we look at core durable goods, we're basically asking, are businesses buying new equipment? Are they expanding their capacity? A low core number suggests businesses are hesitant, maybe pulling back a bit.
Which feeds that narrative of a slowing economy.
Exactly, which, paradoxically, is what the market is kind of hoping for right now to keep the Fed dovish.
Okay, so let's game out the two main scenarios for the listener because the market reaction depends entirely on which way this goes, given the current weird rules of the game.
Right. Scenario A. Let's say this report comes in surprisingly strong, a big beat. Maybe the core number jumps by, say, over 1.0%.
Okay, stronger than expected.
Under the current market logic, that would be interpreted as overwhelmingly negative for stocks.
Negative. Why?
Yeah.
Isn't strong economic data usually good?
Not right now, because it completely challenges the narrative that the economy is slowing enough to need Fed help. If the economy looks stronger, the justification for future rate cuts starts to evaporate. That liquidity leverage the market loves. Gone. Interest rate expectations would probably reset higher very quickly.
Ouch. Okay, so that's the good news is bad news scenario. What about scenario B? This is presumably what the market is actually priced for.
Scenario B, a significant miss. Let's say the core data actually contracts, maybe down menacingly 1.0% or even worse.
Weaker than expected.
This would likely be positive for both stocks and bonds. It confirms the economy is slowing, it validates the Fed needing to cut rates, and it reassures everyone that the easy money policy will continue.
Right. The intellectual dissonance holds. Weak data means more cheap money, which boosts asset prices. Got it.
For now, anyway.
Okay, turning from the macro data to what's happening with individual companies right now. We need to sort the speculative noise from the potentially critical signals in today's pre-market movers. And there's definitely some noise, right? Pure speculative frenzy in some small caps.
Well, absolutely. That's the noise, and it reflects just how high the risk appetite is out there. You've got like speculative biotech and hybrid soaring over 72%, logistics health surging over 115% on huge volume. These are basically lottery tickets, momentum plays. They just show that the mood among maybe retail traders feels safe enough to take these huge gambles right now.
But the broad signal, the stuff that might have fundamental importance, comes from the large cap gainers, especially the tech proxies, right? Supermicrocomputer, SMCI, up 2.7%, Micron MU up nearly 2.5%.
Precisely. That's the market positioning itself for the AI narrative. The strength in SMCI and MU, these companies, make essential building blocks for AI infrastructure, servers, and memory chips. That signals intense bullish bets being placed just before the Mag 7 report.
So investors are betting these tech giants are going to confirm massive ongoing spending on AI.
Which flows directly to companies like Supermicro and Micron.
Yes.
Big AI capital expenditure plans.
Okay. Now let's talk about the critical signal of caution, the one that's really jumping out this morning and seems to directly contradict all that macro optimism. That's the collapse in Deckers Outdoor, the TETK.
Yeah, this one deserves a huge spotlight. Deckers, they own the HOKA, running shoes, UGG boots, really successful brands.
Very successful lately, yeah.
Is down over 15% in the pre-market. 15%. That's the first major casualty we've seen this earnings season in the whole consumer discretionary space.
And the trigger was what? Their forecast.
A disappointing forecast for their 2026 net sales.
Okay, this feels like it could be more than just one company having a bad day. What's the broader implication here? If a hot brand like HOK, owned by Deckers, is seeing weaker forecasts, what does that tell us? What narratives does it challenge?
It raises immediate and frankly pretty serious questions about how resilient the consumer actually is. And critically, it challenges that whole pricing power story we've heard so much about.
Explain that pricing power narrative.
The bullish case for a lot of consumer stocks, especially the premium ones, has rested on this idea that brands like HOK or think Lululemon have strong enough brands that they can raise prices to cover their own higher costs, and consumers will just pay up without cutting back how much they buy.
Right, they'll absorb the price hikes.
Decker's weakness suggests maybe that's not true anymore. Either the sort of affluent consumer who buys these brands is finally starting to pull back on spending, or they're starting to resist those higher price tags, maybe trading down.
So if Deckers, with its hot brands, is struggling to forecast strong sales, which other companies, which peer groups, look most vulnerable to this potential loss of pricing power?
Well, really any company that relies heavily on discretionary spending, particularly from that middle to upper income consumer, you immediately think of names like Lululemon. They've been a prime example of pricing power, maybe even Nike, Adidas.
Okay.
This one stock, Deckers, collapsing like this creates an immediate, tangible headwind for other consumer companies reporting soon, including Whirlpool and Keurig Dr. Pepper, who report later today.
Right.
The Deckers fall is really the first piece of concrete, real-world evidence that directly contradicts the Fed's hope for just benign weakness. It suggests the weakness might already be hitting corporate top lines pretty hard.
Okay, moving beyond today's immediate data and stock moves, the market is now heading into, well, the most concentrated blast of event risk we've seen all quarter. It really kicks off midweek. Let's start with the macro side. The FOMC decision wrapping up on Wednesday, October 29th.
Yep, announcement at 2 p.m. Eastern, Powell's press conference at 2:30.
Now, we've already established that 25 basis point rate cut seems totally baked in, 98% probability. So the market isn't going to react to the cut itself. What is the core risk, the core conflict surrounding Powell's announcement this time?
The core conflict stems entirely from this ongoing U.S. government shutdown. It's now been dragging on for, its second month?
Yeah, it feels longer.
And this shutdown has literally closed several statistical agencies. That means it is actively delaying the release of key official data points that the Fed normally leans on heavily for its guidance.
Like what kind of data?
Crucial stuff. The latest inflation reads, factory orders, the U.S. trade balance figures. A lot of the dashboard is dark right now.
So Chair Powell is facing this almost unprecedented situation. He has to justify the rate cut and, more importantly, give guidance about the future path of rates while being effectively data blind to the most current state of the economy.
Exactly. Data blind is the perfect term. The Fed always stresses how data dependent they are, right?
Yes.
But Powell now has to make his case relying on older data, like that cooler CPI print from last week, and maybe some alternative, less reliable indicators. And the market, meanwhile, is completely leveraged, expecting a clearly dovish message. It needs Powell to sound confident, to assure them more easing is coming if needed.
So the risk isn't the cut, it's the tone. It's the communication.
It's all about the tone. Any deviation, any hint of maybe hawkishness because they're uncertain, or even just expressing deep uncertainty because of the missing data, that could trigger a really significant negative reaction. He somehow has to project data confidence without having all the data.
We've seen the Fed operate with incomplete data before, usually during crises. But the market seems exceptionally sensitive right now.
It feels like a very tightrope walk. If he sounds too dovish, maybe he fuels even more speculation, which you could argue we're already seeing signs of.
Right.
But if he sounds too cautious, if he says, well, we really need to see the data catch up, maybe implies the shutdown makes them hesitant to promise more cuts, boom! He could trigger a sell-off because the market has priced in absolute dovish perfection. It all hinges on how clearly he can navigate this ambiguity.
Okay, a huge communication challenge for Powell. Now, the other massive piece of this week's gauntlet, corporate earnings. The scale here is just mind-boggling. Something like 44% of the entire S&P 500's market cap reports results this week.
44%. It's an absolutely extraordinary concentration of market-moving information hitting all at once.
This is really the week where, as they say, the rubber meets the road for the market's overall valuation.
No doubt. And we start today, Monday, with some really critical cyclical reports. These will either amplify that concern we saw from Deckers or maybe push back against it.
Okay, let's focus on today's reporters. First up, before the market opens, VMO, we get Keurig Dr. Pepper, KDP. Seen as a barometer for consumer staples, the estimate is 0.54 EPS.
Yeah, KDP is a really pure read on demand for everyday items, coffee, soft drinks. After what we saw with Deckers raising flags about discretionary spending, the focus here will be intense on volumes versus pricing. Meaning, is KDP managing to pass on higher costs through higher prices without seeing people buy less stuff? Are the volumes holding up? If KDP reports that volumes are noticeably weak, it suggests the average consumer is really feeling the pinch and starting to trade down or cut back, even on staples. That signals broader economic stress than the market might be admitting.
Got it. Then also BMO, we get Revity, RVTY, that's in Life Sciences Diagnostics, estimate $1.14.
RVTY is interesting because it offers this immediate, real-time counterpoint to all the optimism about U.S.-China trade relations.
How so?
Analysts are specifically flagging concerns about challenges in diagnostics, particularly in China, for Revity. So, if RVTY comes out and confirms they're seeing operational weakness specifically tied to the Chinese market, that casts immediate serious doubt on that big macro trade optimism that's driving futures this morning. It would be a tangible sign that, diplomatic progress hasn't actually trickled down to improve corporate results on the ground yet.
Okay, potential reality check on the China story.
Yeah.
Then, after the market closes, AMC, we get Nucor, NUE, big steel producer, estimate $2.18. Now, given that government shutdown and the missing data, Nucor's report takes on almost outsized importance, doesn't it?
Absolutely. Nucor basically becomes this crucial real-time proxy for industrial demand in Q4. maybe even for GDP itself.
Because we can't get the official factory orders data.
Exactly. With the official government numbers offline, what Nucor says about its order book demand from industrial clients, commercial construction, etc., that commentary will be treated almost like gospel by the market. It's one of the few clear windows we'll have right now into the real momentum, or lack thereof, in the industrial economy.
Okay, Nucor's guidance is key. And finally, also AMC, Whirlpool, WHR Appliances, estimate $1.39. This seems to tie right back to the durable goods data this morning and that Decker's warning.
Yes, perfectly. Whirlpool is a direct read on consumer spending on big-ticket durable items and also indirectly on the housing market. Their results are going to be immediately put side by side with the durable goods report from this morning and the consumer weakness hinted at by Deckers.
So if Whirlpool confirms things are soft in appliance sales, or if they give cautious guidance,
It really solidifies that narrative of consumer degradation, and it broadens it beyond just discretionary stuff like shoes into big household purchases. It paints a potentially worrying picture.
okay, so today is already packed. But now, the main event, the absolute centerpiece of the week, the Magnificent Seven referendum. Reporting Wednesday and Thursday,
This is it.
the entire market rally, pretty much all of 2025, has been built on this narrative of an AI-driven productivity boom. And this week, these five hyperscalers, Microsoft, Google, Meta, Amazon, Apple, they either prove it or they potentially shatter those sky-high valuations.
It really is a referendum on that narrative. Investors aren't just looking for slight earnings beats here. They are demanding confirmation that this AI revolution is real, it's happening now, and it's translating into massive structural shifts in productivity and corporate revenue.
Okay, so what are the absolute key things to watch for? You mentioned it's beyond just the headline EPS number. What are the three metrics that truly matter here?
Right, forget the headline beat for a second. Metric number one, AI capital expenditure.
CapEx?
Their spending plans on AI infrastructure. Exactly. The market needs to see massive, aggressive spending plans continue. This CapEx is literally the revenue pipeline for the entire semiconductor world. NVIDIA, SMCI, Micron, all of them. Analysts are looking for guidance that confirms something like a plus 35% increase in AI-related CapEx over the next year.
35% increase. Wow. Why is that number so critical? What happens if they signal less spending?
If the hyperscalers pull back, or even just suggest the pace of spending might slow down, it implies the AI revolution is either proving more expensive than thought, or maybe it's further off than the market has priced in. A reduction in AI CapEx guidance would be seen as, honestly, potentially catastrophic for sentiment. It would send severe negative ripples through the whole tech ecosystem.
Okay, CapEx is huge. Metric number two.
AI monetization proof. Proof they're actually making money from AI.
Right. It's not enough just to talk about cool AI features. They need to show it's hitting the bottom line.
Correct. Meta actually set a pretty high bar here already, showing how they're using AI in their ad systems to boost results. So now Microsoft needs to show real quantifiable uptake of its Copilot features. Are businesses actually paying up for this AI integration?
Okay.
Alphabet, Google needs to demonstrate that plugging AI into search in Google Cloud is actually accelerating revenue growth, not just acting as this giant cost center because AI needs so much computing power. We need to see AI moving from, like, the science project phase to actually driving dollars on the ledger.
Makes sense. Show me the money. And metric number three.
Cloud growth,
Yeah.
just the underlying growth in their core cloud businesses. AWS for Amazon, Google Cloud for Alphabet.
Why is that still so important, even with all the AI hype?
Because cloud computing is a fundamental engine powering this whole AI revolution. You can't do large-scale AI without massive cloud infrastructure. So if we see slowing growth in AWS or Google Cloud, it's a major red flag regardless of any AI announcements.
Why does slowing cloud growth signal?
It suggests that enterprise customers, their big clients, are potentially cutting back on even essential IT infrastructure spending. That signals fundamental caution about future business conditions. If companies are hesitant to spend on the cloud, it implies broader economic headwinds might be starting to bite, potentially offsetting the excitement around AI. You need the cloud foundation to be strong.
Okay, cloud growth remains vital. And finally, within the Mag 7, we have the outlier, Apple.
Yeah, Apple's the interesting one. They're often seen as the laggard in this group, kind of missing in action from the massive AI CapEx race that Microsoft, Google, Meta, and Amazon are running.
Right, they seem to be playing a different game.
So for Apple, the focus will likely be more on their traditional strengths. How's iPhone demand holding up, especially in China, which is a really key sensitive market for them right now? How's their services revenue growing?
And any hints about their own AI strategy?
Exactly. Any concrete comments on how they plan to integrate AI, perhaps differently from the others, will be intensely scrutinized. The market's watching to see if Apple can successfully pivot from being primarily a hardware and services giant into being a truly competitive AI player, too. And, if their China demand disappoints, Apple carries so much weight in the indices, it could be a serious drag on the entire S&P 500, even if the other tech giants deliver.
Okay, let's try to pull all these threads together. Synthesizing everything we've covered, the sort of unified conclusion seems to be this: that explosive optimism we're seeing in the futures market this morning, it's basically an explicit, very forward-looking bet, a bet on two specific and frankly high-risk outcomes happening this week.
That's exactly right. It is a colossal bet that, number one, the economic data, starting with durable goods today, will confirm just the right amount of weakness, that benign weakness.
Right. Not too hot, not too cold.
Precisely enough to force Chair Powell and the Fed to stay firmly on their dovish path, ensuring that liquidity keeps flowing. And number two, it's simultaneously a bet that the Magnificent Seven earnings will definitively confirm that this AI-driven productivity boom is real, it's massive, and it's happening fast enough to justify these record-high stock valuations.
So you have this convergence of really high expectations hitting this incredibly concentrated period of event risk, the FOMC, the Mag 7 earnings, key data. It creates this coiled spring dynamic, as some analysts call it. We're sitting at or near all-time highs right as we head into the belly of the beast. What does that imply about how the average portfolio might be positioned right now?
It strongly implies the market is completely, utterly priced for perfection. You've got low implied volatility, judging by the VIX index, combined with the sky-high optimism. That combination usually means one thing: the market is not hedging against a negative surprise. People are positioned for things to go right. So, if either of those two big bets fails, if the Fed sounds less dovish than expected, or if the Mag 7 results disappoint on capex or monetization, if perfection doesn't materialize, the resulting unwinding of all those leveraged long positions could be, well, potentially profoundly violent on the downside.
Right. The spring uncoils quickly. So the defining theme for you, the listener, watching things unfold this week, has got to be monitoring for divergence, right? Where could the optimistic narrative diverge most sharply from reality? What are the key checks?
Yeah, two main divergence checks to keep laser focused on. Divergence check number one is macro. Keep watching that intellectual tightrope walk. The potential split between bad news on the economy, like a weak durable goods print, and the market's currently positive good news reaction because it means more Fed help.
When does that break?
It breaks if the economic weakness starts to look too severe. If it shifts from benign slowdown ensuring rate cuts to, uh-oh, maybe this is a real recession hitting revenues. At that point, the market stops celebrating liquidity and starts panicking about earnings. That's the inflection point.
Okay, watch the macro reaction. And divergence check number two. This seems even more critical this week. It's corporate reality versus the hype.
This is, I think, the most essential check right now. We have to monitor the growing divergence between the tangible ground truth reports coming out of the cyclical real economy. The early warning flare sent up by Deckers this morning, the results we'll get from KDP, Whirlpool, Nucor, versus the high-flying, extremely richly valued, future-facing AI narrative embodied by the tech giants.
But what's the risk if those diverge too much?
The risk is if the consumer part of the economy, the cyclical part, materially degrades further, that hugely expensive tech narrative is going to have a very hard time supporting the entire S&P 500 valuation all by itself. This potential split, this growing gap between the real economy's health and the AI-driven future economy's promise, that's the fundamental risk vector for the market this week. Hashtag tech outro.
That is fantastic synthesis. Really helps frame the week. So just to wrap it up for you, the listener, 3 key things to keep your eyes glued to this week. First, Powell's tone on Wednesday. How does he navigate justifying a rate cut while being basically data blind? That communication is critical.
Absolutely critical.
Second, the Magnificent Seven. Forget the headline EPS beat. Focus on their commitment to AI, CapEx. Does it meet that huge 35% growth expectation? And can they show actual, tangible proof of AI monetization?
CapEx and monetization, the twin pillars.
And third, keep watching the signals from the broader consumer economy. Deckers Outdoor served as a pretty stark early warning this morning. What did KDP, Whirlpool, and others tell us later?
Yeah, that ground truth is essential context. The overarching strategic takeaway from all this seems pretty clear. This current setup, High optimism meeting suppressed volatility leaves the market incredibly vulnerable to a shock. Investors have built this quite fragile tower of hope.
And as one of our sources noted, any significant disappointment this week, whether it's Powell sounding a bit more hawkish than expected, maybe cloud growth decelerating unexpectedly, or a miss on that AI CapEx guidance, any of those could trigger an extraordinarily violent downside reaction. The market just seems to have zero tolerance for failure right now.
Yeah, the margin for error feels razor thin, so maybe the provocative thought to leave you mulling over is this. If the market is truly priced for flawless execution on all fronts, how are you positioned for the very real possibility of a rapid, sharp unwinding of all this bullishness? What protection, if any, do you have in place if reality delivers something less than perfection from the Fed and the Magnificent Seven this week?
Definitely food for thought, especially heading into such a packed and pivotal few days. Thanks so much for walking us through the sources and helping us deep dive into this incredibly high-stakes environment.
My pleasure. It's going to be a fascinating week to watch.
No doubt about it. We'll catch you next time.